Easily one of the most popular dividend investments out there is the Schwab U.S. Dividend Equity ETF, ticker SCHD. With over $52 billion worth of assets under management, it's currently the second largest dividend growth ETF behind the much older Vanguard Dividend Appreciation ETF, ticker VIG. As I've discussed in the past, there's a lot of reasons to really like this dividend holding. Not only has it increased its dividends every year since inception, but it's also consistently been one of the highest yielding dividend growth ETFs out there. That means whenever you invest in SCHD, you get paid more in dividends each quarter than any comparable ETF like VIG, VYM, and SDY. SCHD also has the best dividend growth rate than any comparable ETF to my knowledge. This fund has a 5-year dividend growth rate of 13.05%, far exceeding all other ETFs. So there's a lot of good things to like about this investment, but just like every investment, SCHD has both fans and critics of it who have attempted to pick it apart for several reasons. Social media platforms and basically any stock analysis website like Seeking Alpha regularly have people who come on there and basically criticize anything that exists in the market. So in this video, we're going to take a look at some of the most common arguments against investing in SCHD and see if any of them have any merit to them, which some of them do. So let's get started. One of the most common arguments against SCHD that I come across is its recent underperformance. By this point, it's no secret that SCHD had a pretty bad 2023 compared to other funds like VIG, VYM, and DGRO. It's done better than SDY, but last year was a disappointing year for the Schwab ETF. The number one best performing dividend growth ETF last year was VIG, and the reason for that boils down to its holdings. The top performing sector in 2023, according to this website, was technology, which saw huge gains across holdings like Nvidia, Apple, and Microsoft. Tech is VIG's largest sector, which according to Seeking Alpha makes up almost a quarter of its holdings. As you might be well aware though, tech stocks aren't well known for paying huge dividends. For example, Nvidia currently yields a measly 0.03%, Apple yields around 0.5%, and Microsoft yields around 0.8%. Nobody invests in the tech sector expecting to collect huge dividends, with the exception of some ETFs and closed-end funds that either use call options or trade stocks within them and distribute the gains in dividends. But there's two obvious downsides to these ETFs holding so many tech stocks. The first is a lower yield. VIG only yields about 1.8% compared to SCHD's 3.5%. That's almost half the dividend yield compared to the Schwab ETF. The second downside is that these tech stocks often don't grow their dividends very fast. VIG's 5-year dividend growth rate is 9.5%, which is still really good, but just not as good as SCHD's growth. So if you're deciding which ETF is best, you'll have to decide which is more important to you, dividend growth or share price growth. If your goal is to live completely off dividends someday, it makes sense to prioritize dividend growth and not share price growth, since selling off your principal isn't the main goal. If we look at VIG and SCHD side by side in terms of total return, SCHD has done better with its higher yield than VIG's share price growth. This feels like another good gateway into another really popular argument against SCHD, which is that it underperforms the market. I've seen people compare SCHD with other popular market ETFs, usually SPY, which is the S&P 500 ETF. If we try running both through a drip calculator, we can see that for the majority of SCHD's existence, SPY has in fact been the winner when the two are compared to each other. But making this argument against SCHD I think is useless for a really important reason. People should only invest in SCHD if you're trying to live off dividend income. SPY and SCHD have two completely different strategies going on. SPY tracks the S&P 500, which measures the performance of the large-cap stock segment of the U.S. equity market. SCHD tracks the total return of the Dow Jones U.S. Dividend 100 Index, which is an index that's designed to measure the performance of high dividend-yielding stocks in the U.S. market with a record of consistently paying huge dividends. Everything inside of SCHD is selected for their fundamental strength relative to their peers based on various financial ratios. In other words, SPY is for index fund/growth investors and SCHD is designed specifically for dividend and income investors. If your goal isn't to eventually live off dividends, it doesn't make sense for you to invest in SCHD in your portfolio. Likewise, people like myself who invest exclusively for dividends have really no reason to hold SPY. Now, if you personally want more diversification in your portfolio outside of dividend holdings, then that's completely fine, but nobody holds SPY in their portfolio specifically for its dividend. Right now, SPY only yields 1.4% because it's not designed to target specifically dividend stocks. SCHD does target dividend stocks that yield more and have long consistent track records of raising their dividends. These kinds of companies often don't grow in share price very much because they're in more mature industries that aren't well known for explosive growth. With that being said, it's unlikely that in 10 years SCHD will outperform SPY even if you reinvest your dividends. But you should be okay with that if you are a dividend growth investor. If you want to pursue dividend growth investing specifically and not income investing, then you should prioritize securities that offer dividend growth first, a good yield second, and then share price growth third. So this argument is really like comparing apples to oranges. Dividend growth investors should not target SPY, and index fund investors should not target SCHD. Another criticism of this ETF I've seen has to do with SCHD's yield being considerably low by some standards. Although it's the highest yielding dividend growth ETF to my knowledge, some people have said that its yield of 3.55% is still too small and that your money would be better off in other higher yielding assets. For example, this author says that it's better to invest in treasuries because those are practically risk-free and yield over 5%. It's another bad argument considering the fact that interest rates might get cut, and if that does happen, then treasuries are also going to get cut, but SCHD's yield won't change. You might remember when government I-bonds were really popular back in 2022. At the time, these things were offering an almost zero risk yield of 9.62%. But the issue was that this was only for a limited time between May and October of that year. Currently, Series I savings bonds are now yielding 5.27%. But this is still historically high, and once rates get cut, then this number will go down. So I don't think that this is a valid argument to make either. On the other hand, if you do want to pursue higher yielding investments like covered call funds, business development companies, and real estate investment trusts, then that's fine. But with a lot of these types of investments, specifically with the high yielding stuff like BDCs, CEFs, and mortgage REITs, the only dividend growth that you'll experience is from reinvesting all of your dividends. As I repeatedly say over and over again on this channel, if you're solely an income investor, meaning that you don't earn any income from a job and you're depending on dividends for your income, I would still suggest holding a dividend growth ETF like SCHD. But this again I think is not a good argument. People make an investment in SCHD specifically for dividend growth. That's what these investors want, and treasuries don't experience the growth the way SCHD has. When I-bond rates jumped to 9.62%, it was a really shocking event that was well covered on CNN and CNBC. This isn't something to be expected normally from treasuries, and even less so when rates get cut. Finally, one more argument against SCHD is that it's not as well diversified. This, in my opinion, is actually a decent argument to make against it. In a video where I compared the top 5 dividend growth ETFs, SCHD was actually the worst when it came to diversification. Currently, this ETF only holds 104 securities, which is a lot less than VIG, VYM, SDY, and DGRO. It has to do with SCHD's strategy in picking very specific dividend stocks versus holding every or almost every dividend-paying stock in the market. The Schwab ETF uses some different financial metrics from the other ETFs, which is why they hold fewer investments. Although the lack of diversification is maybe the most concerning issue for it, when I reflect on its track record, I'm not scared away from holding it. Honestly, holding over 100 different companies isn't exactly lacking diversification in my opinion. It still holds stocks in a lot of different sectors, including industrials, healthcare, energy, materials, and utilities to name a few. In the end, I know 2023 was a pretty disappointing year for this ETF, but the long-term performance attests to how good of an investment SCHD has been. The majority of these websites and articles that try to attack this ETF I think are mostly clickbait articles. This is when an author tries to reel you in with a controversial article title in the hopes that you'll click on it so they can collect more ad revenue from the article. I don't see any flaws in SCHD that I think should turn away any dividend investor out there. Like I said, whether you pursue SCHD or some other dividend growth ETF that I've talked about, it's pretty hard to go wrong with this asset class. But with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus, it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.